Everyone, Marco Palmero, founder of Ulysses in Dubai, and welcome to another episode of Acquisition Case Studies, where we take deals that we have sourced and negotiated in the past, we analyze them, and then we find out what the takeaways are. So mistakes we've made, lessons we took away from these negotiations. And I think this series itself is focused on our own deal flow because we want to share our personal experience in the United Arab Emirates and in the Middle East so that we can potentially help all the business leaders, entrepreneurs, investors looking to buy assets in this region. So again, we will analyze our proprietary deal flow. In today's case, we will talk about private equity. And so a group of companies that was offered to us and that was available for sale. So it will be a little bit more complex because generally I give you the breakdown of the deal. I keep everything confidential to avoid sharing any sensitive information. But for this particular case, we will need to dive a little bit deeper into the complexity of the deal because we were talking about many different assets at once. So hopefully I'll break everything down with sufficient clarity. Let's dive into the case and let's talk about how we got offered this deal. So as we were going around looking at deal flow for ourselves and for our clients, we many times stumble across private equity groups, right? Thankfully, in the small business arena, there are less private equity groups that do deals, which is good for us and for other people like yourself, who might be looking at opportunities, because in many cases in the United Arab Emirates and in the Middle East, groups like them target big ticket items, big ticket acquisitions. So we're talking $50-100 million plus. If you go below that level, a lot less competition. People don't really touch that space for all the obvious reasons. So it's not convenient for them. It takes the same amount of time to do a big deal than a small deal. The returns they can generate out of a big deal are much better, so on and so forth. So for all these reasons, we rarely stumble across private equity. But in this case, we we're invited to a meeting where a group owning a portfolio of small businesses was interested in divesting the entire portfolio. And they had operations in different countries of the Middle East. So they were fundamentally getting rid of everything in that sale. Now, the rationale behind that was that they were looking at new investment opportunities. They were pursuing opportunities in other geographies. And so they wanted to kind of get rid of that arm of their business and focus on something else. That was kind of like the opening statement of that group as we sat down with them. As we received the information on deals, we saw that they had quite a decent portfolio, although some assets were not really performing well, and we will talk about the reasons later. But there were a lot of assets to look at, which was very good because they didn't say to us, we want to sell all the portfolio together. They said, we're just divesting every single asset, and we will be open to accept offers for any business separately. So that was good news because if there was something specifically within that portfolio that was of interest to us, we could have bought it and potentially get a good deal out of it. So let me give you a little bit of a breakdown of the deals that we had. This opportunity came to us about 12 months ago, so I still got a little bit of a summary. Hopefully I will not create a lot of confusion because on a video there will be a lot of information, but we were talking fundamentally about 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 assets. So 11 separate businesses that these guys were looking to sell. Now, to proceed in order, I will give you just the breakdown of the revenue and potentially how many people were involved in the business if it is mentioned here. So the first business was generating little to nothing really. It was a new center they opened. It was just generating about $200,000 a year in revenue. And I think the problem with this center, and we will get to those reasons in a second, was that by looking at the historical performance, it went down like a rocket falling off the sky. In 2018, they were generating almost 15 times the revenue of 2023. So fundamentally, there was something that was not right in that business, which of course made us pass on that deal. But I think that gave us initial red flags that then led us to dig deeper into the reasons why the group was divesting all these assets. And we will talk about that later once I'm done giving you the summary. So this business was simply too small, not worth bothering. It was just the next. Then the second facility was a bit more interesting, was generating about $750,000 a year in revenue. Still very small, but they had a good distribution of the key employees who were generating the revenue. There was not one person that was the main guy. So it might have been interesting in terms of growing it and taking it to the next level and maybe integrating into another business that was much bigger in size. Again, here, same issue happened. We saw that the revenue was declining consistently from 2018 to 2023. So we felt, that could have been a bit of an issue because all these assets started to look the same, right? And again, I said to you around $750,000. In 2018, they were generating almost 10 times that amount. So something was not adding up in these businesses. Now, third asset, again, a good business. This one was a little bit more stable. So it was a $1 million a year in revenue business, stable over time, appeared to be a decent opportunity, good employee count, solid profitability. It appeared to be a good target overall and to be further analyzed. Target number 4, not to bother, $200,000 a year in revenue, very, very small business. Number 5, again, a decent sized business, $4 million a year in revenue, but again, revenue declining consistently over the years. Same applies to, again, business 6, business 7, business 8, 9, and 10. So fundamentally, just to give you a summary here, because I don't want to bother you with too many figures that are going to be difficult to track in a video. We had a lot of businesses that were small in size, so they were a one shop or a one location business that had declined over the last 5 years. So there was a trend there, and it needed further analysis. And even the assets that were that were stagnating, so they were performing at the same level, might have had issues that were not, disclosed on paper. So we needed to understand why all these companies were declining and why they were performing so well 5 years ago, right? Of course, you might say there was COVID in the middle. There were a lot of challenges that people needed to go through. But in the United Arab Emirates and in the Middle East, we saw that challenge happening during COVID, but then a swift recovery from most of the businesses. And thankfully, especially in the UAE, we had a very short time frame where businesses were totally closed. It was around 3-4 months, but then the government did a very good job at opening up the country again. And so businesses were not stuck like in Europe or the United States for a long period of time without having the ability to get customers through the door. So the situation was a bit different, and COVID was not really a justification in this case. So long story short, a lot of businesses in this portfolio that could be of interest, others just not worth bothering, but we needed to get a little bit of detail around why that was the case, why these businesses were performing this way. So we sat down with these guys again, we asked them about it, and we fundamentally wanted to know, why is it that basically every single business in your portfolio has decreased the revenue and the profit over the last 5 years? And it appears very weird, right? These guys initially tried to, find some sort of excuses, right? Blaming the market, the COVID, and all these sorts of things. But ultimately, what came out was that management was facing some problems, some challenges. They were trying to divert their attention from this particular portfolio into other portfolios they had and that they were managing. And what happened was that they were struggling financially. So fundamentally, the business over the last 3-4 years was not performing well for this private equity group, and they were progressively going bankrupt fundamentally. So they took the foot off the accelerator for all these assets, and they stopped overseeing and managing these companies actively. So what happened then was, we asked, what is the current situation of the company, right? Because you said that you might be facing bankruptcy. It doesn't appear to be good news, right? They said that they were planning to stabilize the situation, and one of the reasons why they were getting rid of this portfolio was to stabilize the situation. And so there we got the final motivator, the reason why they were exiting that portfolio. It wasn't really that they had a change of mind, they had new objectives and stuff like that. It was really that the group itself was bleeding and they needed cash in to recover some of their losses, right? And so they were exiting all this portfolio to solve that problem. Now, nothing wrong with that. It might have been a good opportunity for us to get some assets at a very good price, huge discount, especially if those assets were already performing well. But as I said, most of them declined, and they were constantly declining. Even the year to date were not promising. And so we thought there was something bigger going on over there that wasn't really just these financial problems. And what we realized 4 or 5 months later was that the entire group was going to be liquidated. So a liquidator got appointed to liquidate that entire business, and they started the process of liquidation to just solve all these financial issues that they had. So fundamentally, they were trying to get rid of these assets as quickly as possible to avoid going through the liquidation process, but they weren't able to manage that. And so it's funny because since we talked with these guys a few months before the liquidation process started, we then got called by the liquidator himself saying, well, if you want to purchase some of these assets, we're going to take care of that process anyway, so we can sell you some of those. And despite the fact we looked at these assets again, the situation was terrible. There was no way we could just take these businesses and make them go up in value again. They were on a downward trajectory, and was just a terrible problem that they were facing. So not sure if the liquidator managed to sell all these businesses and kind of like get rid of them. But I think the biggest lesson we took away from that was that private equity always had some reason why they're exiting these investments. And the general excuse, we're pursuing other interests or we're targeting a new market, isn't really going to cut it. Generally speaking, there's something hidden that might not necessarily be a bad reason. Like in this case, it might be a good reason. The point we realized there is that it is always important to dig deeper before you commit to a deal. And thankfully, in this particular case, the vast majority of the assets in the portfolio showed a downward trajectory, which kind of helped us uncover these red flags, because it might have been that 7 out of 10 assets were stagnating and 3 were on a downward path. We might have said, okay, it might be a coincidence. We're going to buy some of these stagnating ones and push them up in value again, since these guys are not focusing on them anymore. And again, we might have ended up into a bad situation. In this case, it was evident that the entire group was falling apart. And so we kind of got a good and solid red flag earlier in the process. So we avoided, expensive mistakes. Let's just put it this way. So I guess the reason why I wanted to record this case study was to share this lesson that I learned, to always dig deeper, even when you deal with professional private equity groups, because everybody has reasons for selling businesses and exiting assets. Those might be good or bad reasons, but it's important to get to the bottom of it and understand why are they really undertaking this process. So fundamentally, that's the lesson I took away from this deal, which of course didn't close because we passed on it. And I will see you in the next one.